All right. Welcome to the Homeowner Connection. My name is Danielle Wilson,
And I'm Tracy Cooper.
and we are local real estate agents in the Spring, Texas area. And our goal is not only to help you to find your dream home, but we are here to help you to connect to local industry experts in the real estate field. And today we are joined by Sharon Eldorado, who is joining us from New American Funding. Thank you and welcome, Sharon.
Welcome.
Thank you. Thank you for having me.
Thank you.
So today we are here to help first-time home buyers in their lending process. Okay. So let's jump into it. How early should first-time home buyers meet with a lender, especially if their credit needs a little work? And then what exact documents are they going to need for their process?
So I think most home buyers, when they start looking for a home, don't look at their credit in enough time to fix it. So I would recommend that they start looking at anywhere from 6 months to a year, depending on what information they have that is showing up, or someone is sent them documentations and they needed to pay some things off, or you've got a collection. 6 months to a year, start pulling your credit. Make sure you pull it through someone that can do a soft pull where it will not affect your scores, but you definitely want to pull it 6 months to a year so you'll have time to fix it if you need to spend the money to fix it.
Well, does it matter who they go through? Does it matter if they go to a specific lender or a credit union or anything like that? Does it matter who they go to?
I think so, because not all lenders can do a soft pull, right? Some lenders will do a hard pull, and the more hard pulls you do, it's going to affect your credit scores. So you need to really look for a lender that can do a soft pull, which means they will pull either two scores or they'll pull three, but it will not be credit affecting. So if you have credit monitoring, you will not even see it, it will not notify you. Whereas if you do a hard pull, you're going to get a notification that somebody pulled your credit.
Wow. Okay. So, what if the buyer is denied, and how can you help position them to be successful in the process of
Okay.
getting a loan or being credit having?
Say it again, because I think you can cut, right?
Yes,
You can edit.
that's okay.
Go ahead.
Okay. What happens if a buyer is denied,
Mhm.
and how do you help position them for success?
Okay, so if a buyer is denied at that time to purchase a home, the one thing you want to understand is why they were denied. Is it due to credit? Is it due to income? Is it due to assets? Right? So once we determine what that is, then we can fix it, right? It might take a little longer for if it's credit, 6 months to a year or less, depending on what it is as far as credit. When it comes to assets, that might take you a little longer if you have not been saving, or if you don't have a 401k, or if you don't have a little bit of money in a checking account, or if you're not getting your tax returns in where you're going to have the money to put down or do closing costs, right? So it depends on why that person was denied. I can look at that and help them understand how long it's going to take for them to move to the next step, right? Buying a house, you should not look at it as my not being able to do it, just not being able to do it right now, right? It's a right now.
Okay. What is the average timeline for the process? And is the timeline different for an FHA loan versus a conventional loan?
So it if your credit is good, your assets are good, your income is good, then we can actually close a loan between 25 and 30 days, right? So if you're not in an apartment complex where you're in a lease, and now I've got to look at, well, I can't get out of my lease because I don't have a buyout on my lease, or I don't have a reletting fee where I can get out of my lease, then it might be a little longer, because now you've got to consider the other factors that determine whether you move or not, right? But a standard loan takes 25 to 30 days to do if everything is in place.
That's the loan. What about the pre-approval process?
Pre-approval process takes me about a day and a half.
Okay.
Right? If they see, because what the customer has to do, I will send them a link, right? Once they get that link, they can go in and do their application. Once that application is completed and they have uploaded their documents, pay stubs, W-2s, bank statements. You've uploaded those three major things. Those are the first three things that I look at. then I can determine what you qualify for once I pull your soft pull of your credit.
Mhm.
So getting a pre-qualification might run me a day, day and a half, depending on how quick the customer does their part, because I can't do it without them,
Mhm.
right? So they have to contribute. They have to contribute the information, so I'll have it to look at.
Okay.
Don't do an application without putting your income documents in there.
Mhm.
Okay.
All right. So this is not, oh, did you have a question?
I did have a
Okay.
question.
Okay.
So for pre-qualification, and we're going to talk about different different things down the road, but for pre-qualification specifically, if you have like dings for medical bills or dings for different things, does that hinder you in the pre-qualification process?
So it could. Medical will not.
Medical will
Absolutely,
not.
medical will not do for pre-qualification, and it will not do for a final loan either.
Okay.
Right? We do not look at medical. We don't delete it. We just actually reclassify it and we exclude it, because everybody has medical, and sometimes you don't find out about the medical for 30 days, 60 days. Sometimes it's months before you actually find out that you have a medical bill, right? And then you don't know whether the insurance is going to cover it. So we will actually exclude the medical. Now, if you have a collection, charge off, judgment, then yes, that's one reason why you want to start early enough, so we'll know what to do with those collections, right? Especially if it's a judgment. Collections, I can use those if they're not too bad, right? You don't have too many, because with collections, I include 5% of the outstanding balance in your debt ratio. Even if it's 10 years old, if it's still showing up and reporting, I have to include 5% of the outstanding balance in your debt ratio, which means now my debt to income ratio is going to go up because I've included a collection that you haven't probably considered for 10 years, right? If it is a charged off account, again, depending on the age of it, in most cases I exclude it. The only thing that really will hinder you is if it's a judgment.
Okay.
Because you have to pay that.
Yeah.
And what about education? Same kind of a thing?
It's student loans?
Yes.
Right.
Oh, yeah.
It's a whole nother beast.
Whole nother animal,
Okay.
right? So with student loans, most people will tell me, hey, my student loan is in forbearance. Doesn't matter. I have to include a payment on your student loan. Depending on the type of loan I'm doing will determine how much I include. If I go Fannie Mae, and I will include 1%. If you do not have a payment identified, if a payment does not show up on the credit report, it can be $1, and that's all I will include if it shows up on the credit. If it does not, if it shows up at 0, and I have to go Fannie Mae for your loan, Fannie Mae says I have to include 1% of the outstanding balance. FHA is 0.5%, 0.5. Freddie Mac is 0.5. VA is 0.5% divided by 12. So it's a calculation that we have to look at to determine how much we put in there. Okay. So student loans will always affect you. They will always affect you. Even if you do not have a payment, I have to include one.
That's great for people to know.
Yes,
Yeah.
it is.
Yeah.
It is, because most people think that their loans, I don't have a payment because I'm in an income-based repayment, and that income-based repayment is 0. Well, FHA does not care. FHA says, sorry, you're in an income-based repayment and that payment is 0. Sharon, put in 0.5%.
Wow. I wish mine was 0. So doing the underwriting, how do you provide updates during underwriting? Is it weekly calls, text messages, or is there a portal that the applicant has to go through to receive that?
So both, right? So we do calls to the clients, calls to the agents. They also get an update through email to let them know what the status of their loan is, where it is, right? And if there are conditions needed, my processor and my assistant will actually send them an email that said, these are the documents that are needed. Can you email them to her? I always ask that they copy me just in case the processor loses it, right? Which is very, very, very rare. But I prefer being on copy, so that way I know that you've done and taken care of your task.
And a lot of people don't check their email, so it's good that they can have text too.
That's correct.
For sure.
Yeah, I absolutely love text messaging because
it's quick and
sometimes,
easy.
you know, I may get in 100 emails today, right? So yours, when I'm scanning, looking for important documents, I may miss it. So I prefer a client to text me, even if they have a question, text me, right? And I will respond to you. I'll get back to you.
Sure. Sure. So that clients are prepared. Because I think that clients have a number in mind. Like if I have my down payment and if I have this amount of money in reserve, I should be okay, right? But realistically, how much liquid cash should buyers keep in reserve after they've closed, like they've completed the process, so that they're not okay. I'm in my home and now I have nothing. So they're not house poor once they've completed the process.
So if you're asking me how much do we require,
not how much
right?
we require, what's realistic,
Yeah,
so they're not in there now we can't eat.
Yes.
Right?
Realistically, I would say have anywhere at least 2 months. At least 2 months, because most people don't realize that mortgages are paid in arrears, not in advance. So if you're in an apartment complex and you're looking at August, your rent is due August 1st, right? And it covers you for the full month of August. Well, a mortgage doesn't, right? So if you close in August, your first payment is not until October, but you're actually paying for September because it's paid in arrears. It's not paid in advance. So once you close, you're going to have 30 days where you don't have a mortgage. So that's one payment. Now, if I have 2 more payments in the bank and something comes up, car breaks down, I need to put new brakes on, need to put new tires on, at least I have a cushion of about 3 months of a mortgage payment. Now, that is wishful thinking in most cases. It really is. So I would say that if a client had at least 2 payments, they would be good. So because you're not paying the first 30 days, that's one, and you have one in the bank at the time of closing. That would actually give you 2 payments, right? So if something came up, you would have the money to take care of it and not say, oh, I can't make my mortgage payment by the 1st or the 15th, right? You definitely want to be able to do that.
So 2 months.
At least 2.
At least 2 months. Okay, so back to money again.
Okay.
How do you itemize total cash to close for first-time buyers so they're not surprised? There's no surprises.
No surprises. So what I do when I am looking at a bar and qualifying a bar, right? I actually pull everything that I think the bar is going to have to pay. So from taxes, insurance, appraisal fee, inspections. Usually I do not put the home inspection on my estimate, but I will put everything else, right? I look up the taxes to determine what the taxes are going to be, and I'll give you credit for the homestead. So I know how many months should be in your escrow account. Homeowners insurance, I get a quote to determine what your homeowners insurance on that house is going to be. So you know up front what your escrow amount is and what your total amount is. So when I send you out a summary of your estimated cash to close, it will have everything on it.
No surprises.
No surprises.
All right. So let's get into down payment assistance programs. Okay. Do you underwrite specific in-house down payment assistance programs? And again, are there any specific ones that help folks who have no cash reserves? Just anything that can help with people who have nothing.
Okay, so there are several down payment assistance programs here in Houston, right? There are a lot of them, right? With the down payment assistance programs, they can be used toward down payment and closing cost, one or the other. Sometimes you may have a little bit left. If you need the down payment, it'll cover all of your down payment, and then it might cover between 1 and 1.5% of your closing cost, right? So you can use that type of program, but that means that if the seller is not giving you closing cost assistance, that means the additional closing costs you would have to have yourself. Most of the programs will allow up to 5% of assistance. You've got some in the city and the county that takes in consideration more than that, right? Depending on where the house is, will determine how much money you get. Now, you can use that again for down payment and closing costs. It just depends on how much down payment you need in order to help you qualify. Most of the programs that I use will allow you to go up to 5%. We have an in-house program as well that will do 5%, and it doesn't require you to stay in the house any length of time. Okay. Some of them have requirements that says you have to be in the house 3 years. Otherwise, the money that they gave you is not forgiven. You have to pay it back based on a prorated amount. The one that NAF has doesn't have that requirement. So I look at all of them to see which one is going to better suit the client.
Okay, great.
So how many times do you pull the credit? Just once, or?
The initial time when I'm doing a pre-qualification, I pull it once. Because I pull a soft pull. Okay. Now, when they're actively out looking and they're interested in going forward with buying, that's when I pull a hard pull. And I do that only one time. I try to do it only one time. It just depends on how long they take to find a house, right? So you definitely don't want to go beyond 90 days, right, for that credit report. Otherwise, we need to pull again.
Okay. So you just answered my next question. How long does it last for the approval letter for them to go out?
About 90.
And then also, it's super important for folks to understand that the credit gets pulled again.
It does.
So they should not get out there in the streets and buy new furniture or buy a new car, because then they get to the closing table, their credit gets pulled again, and then what happens?
So if the credit is still good, we will not pull it again if it's still good. Now, if we get a notification, because we have your Social Security number, right? So if we get a notification that Jane Doe has just bought some furniture from Gallery Furniture, we will get that notification that she's used her credit. At that point, we're asking the client, what did you buy, right? Do you have, did you open a new account? If they say yes, then they have to provide to us the statement showing how much they owe and what they have to pay, right? So we try not to pull it again, but if you have a lot of activity, it might get pulled again.
But
because
it
we
could
need
affect,
to make sure it could affect the approval.
The sale, right? It absolutely could affect the sale.
Right. So it may be a situation where you now have to pay some things off in order for you to qualify. And if you don't have the money, you don't want to put yourself in that position. So the discussion with me is, if you're interested in buying and ready to buy, do not, after I give you your pre-qualification, do not buy anything else. Don't buy anything else. What I want you to do is manage your credit, manage your debt, pay things down. Don't pay them off, but pay things down, right? Unless you just have a lot that you need to pay off in order to make your financial picture more comfortable once you do get in the house. But in most cases, I'm going to say absolutely not. Do not go to get in any more debt, because it's all it's going to do is increase your debt to income ratio, and it could bring your credit scores down.
Please listen to your agent and your lending officer. Please do not.
Absolutely.
Please don't do that to yourselves, folks.
Absolutely.
Continuing on with down payment assistance programs, do any of them or most of them require homebuyer courses for approval?
They do. Most of them require homebuyer down payment assistance programs that you can do online, right? Very few of them require in person. The internal one to New American Funding does not require a class.
Wow.
And what do they learn typically in those classes?
How to manage money, what their payment includes, principal, interest, taxes, insurance, how to budget. It just asks them questions about their finances and kind of goes through all of that with them. So they'll think about things that they haven't thought about because they haven't owned a home, right? Inspections, maintaining a house, things like that is what it asks them. Nothing hard, right? I have had clients that call me during the time that they're doing their home buyer class, and they're very simple questions. They aren't difficult at all.
But they learn a lot.
They do.
So are the DPA down payment assistance program income limits based on the borrower qualifying income or total household income?
So most of them are qualifying income for the borrower. Most of them are qualifying income. So let's say you have a two-family household, right? And you're going through FHA and you're going to use T-Check, right? If you are the only individual on the loan, then I'm only looking at that individual's income. Now, remember, Texas is a community property state. So even though I may only use the wife's income, I still have to look at the husband's debts because it is a community property state and we have to look at all debts, right? With NAF, one great thing about NAF is that we will allow elimination of some of the debt, depending on what it is, whether it is an essential debt or non-essential.
What's considered
essential is if you have one car in the family and there is a car payment, right? And the husband has the car payment on his credit and the wife does not. But the wife is the only one that's qualifying. I now have to include that car payment in her debt to income ratio if they're doing the FHA loan. If they're doing conventional, I do not, right? Because conventional doesn't require that I pull the spouse's credit. Only FHA does and VA. Mm-hmm. A lot of stuff to look at.
Right.
Not as straightforward.
That's why they need you.
Right.
Right.
It's not as straightforward. So there are things that we have to consider when we're looking at bars that most people won't think of. The client is not thinking that way, right? It's just like the student loans. Oh, I don't have a payment at all, right? So they're thinking, you don't have to include that. Well, yes, I do.
Yeah.
And that's why it's so important to start early. It's not a last minute thing. It's so important to start early because you don't know what you don't know.
Yeah.
That's correct.
And it's a process.
It's a process,
It is.
right? Are there credit score and income limits for the debt to income, and then the
DPA?
Lord have mercy. Yes, thank you so much.
Yes, yes. There are credit score limits, and there are income limits for all DPAs, right? Some of them, if you go through the city or Harris County, the income limits are based on family size, and they're based on area median income requirements. The more, I'll say the ones that are used more frequently, right, do have income limits, and the income limits are fairly high, right? And like I said, if I only have one bar on the loan, I'm not looking at the second bar's income. I'm only
What's
looking
the
at the primary
range? Can
bar's
you
income.
share kind of what a range would
So-
be for the credit score and the income limits?
Usually in Harris County, it's somewhere around 100, 110,000.
Okay. What about the credit score?
Credit score 620.
Okay.
Right. My internal DPA is 580, and there is no income limit.
Okay.
So sometimes I look at that because now also with the DPAs, right? The DPAs will tell us what rate we can sell. Right. It's not market. Most people come in and say, "Oh, can you get me, 5.5%?" No, I can't, because the DPAs are not there. That's not their rate. So if you go through the NAF internal product, it is market rate, right, that we get for you based on your credit. With the DPAs, it is not market. It is what they publish for that day. So depending on how much you need under the down payment assistance will determine your rate. 2%, 3%, 4%, 5%. 5%, the rate is going to be higher. The last time I looked, 5% on a conventional loan at 80% AMI was around 7.5, and if you went FHA, it was around 6.75. Now, those percentages change every day depending on how much money they still have to give. Okay.
So with the DPA, is it a true grant or a soft second mortgage?
So it's a soft second. They do have a grant, right? They do have a grant, but the money runs out on the grant much faster than the soft second. Usually with most DPAs, they are forgivable after 3 years, right? Which means, and the interest rate associated with that loan, right, for the soft second is on your first, because your second doesn't have a rate. It is forgiven after 3 years. But remember, I said the interest rate on an FHA was around 6.75, right? That 6.75 is going to stay with you for 3 years. Even if rates drop down to 4%, you're still at 6.75 for 3. right? The only time, if you decide you want to sell or refinance, then you have to pay the balance of that DPA that they gave you, right? It is prorated. Okay.
Okay.
Wait, it's a lot.
I know.
It's a
Yeah,
lot, people.
Now, how do you use temporary or permanent buy downs to lower the initial payments?
So the temporary buy downs go off of what your prevailing rate is. So let's use a hypothetical so you understand what I'm saying.
Okay.
Right? So if I purchase a home and the interest rate for you is 6.5%, right? I calculate what that monthly payment is at 6.5. Now, if you are able to get a temporary buy down, either a 1-1, a 2-1, or a 3-1 buy down, which means the rate adjusts. If it's a 1-1, it adjusts down by 1%, right? So a 1-1 at a 6.5 would start off at 5.5. A 2-1, it'd start off at 4.5, and a 3-1 would start off at 3.5, right? So what happens with that is you still have to qualify at 6.5. Still have to qualify there. However, your first year or your second and or third year, right, the payment will be reduced by that reduction in the monthly payment. So I don't have to calculate this out. Let's do hypothetical again. Let's say at 6.5, my monthly payment is $1,500. My principal and interest $1,500. But when I look at a 2-1 buy down, right, my interest rate now is going to be at 4.5. So if my payment at 4.5 is $1,200, that means I'm saving $300 a month. So I'm at 4.5, I'm going to pay $1,200. At 6.5, I'm going to pay $1,500, right? But on the 2-1 buy down, I'm only going to pay $1,200 for 12 months. The second year, I'm going to pay, let's say, $1,350 in the second year, and then the third year, I would end up paying the full $1,500. So it reduces your monthly payment depending on the buy down. Now, that's not saying you're not making that payment, because you are, right? So what happens with the money that's in the buy down is that think of it as a bank account that's in your name. That difference in that monthly payment, and we determine what that is for 12 months. So if I'm at a $200 difference for 12 months, that goes into an account. Then the next year, if I'm at $100 difference, that goes into an account. So now I've got $5,000 in that account, right? So every single month, the lender pulls from that account for you to make your full payment. So your full payment is still being made. It's just not being made by you, right? Because the seller has helped you with that buy down, right? And that is required. If you're doing a temporary buy down, you want to get the closing costs from the seller in order to initiate the 2-1 or the 3-1 or the 1-1 buy down.
Perfect. Thank you.
So with the DPA, does it only cover the closing costs, or is it strictly for the down payment?
It can actually cover both, depending on how much of the DPA you get, right? So if you get a 5% DPA and you're doing an FHA loan, the down payment is 3.5%, right? So that means I have 1.5% that could go toward closing costs. So, but if I do a 4% DPA and my down payment is 3.5%, I don't have really anything to go toward closing costs, right? So it just depends on how much you're getting within the DPA as to how much can go toward closing costs. Okay.
Can you remind the viewers who is considered first-time home buyers?
So a first-time home buyer is anyone that has not owned a home within 3 years. The most recent 3 years. The most recent 3 years. If you have not owned a home, you're a first-time home buyer.
So I can go and buy another house.
You can. But some of the programs don't require it as well, right? Some of the DPAs don't require you to be a first-time home buyer. So it really depends on the client situation as to which program we use. Okay.
And I think you answered this question, so I'm gonna defer the next question back to she answered mine.
Well, all right then. So when we're starting out with our new clients and they are wanting to go and visit new homes, we are required to have a pre-approval letter prior to going out. Can you help us to explain to our viewers why that is required, why that's necessary?
Well, you need a pre-approval letter because you want to show a client what they can afford. if you just start looking at homes, the client could, one, get the impression that they can afford that house. Then once they do the pre-qualification with me and find out, well, you can't afford this $400,000 house, the price point for you is $230,000. Now you have to communicate that to the client. You also have to show the client the difference between that $400,000 house and the amenities there and what the $230,000 house looks like, which at that point the client is disappointed.
For sure.
So you don't want to disappoint them up front. You want to make sure that you show them what they can afford so they don't have expectations that they cannot meet.
Right. So it's helpful for both of us.
Yes.
Absolutely.
It is.
Yes. So Sharon, thank you so very much for visiting us at the Homeowner Connection. Is there any last parting words that you would love for those watching to know? Any parting words of wisdom? So
I would say the most important thing is for clients to be prepared. I've had so many clients that are truly not prepared. They haven't looked at their credit. They don't even understand what they can afford financially. They have not sat down to look at a budget to say, this is how much we have going out. This is how much we have coming in. So, and we're paying $1,200 for rent. We can afford to pay $2,000 in rent or $2,000 toward a mortgage. They have to understand where they are, because that's what I'm going to do with them, is help them understand better where they are. And sometimes it's disappointing when you come in and you think that you can purchase a house for $1,500 and you can buy that $400,000 house for $1,500, and you can't, right? Or even $2,000, you can't, and that you need money and you haven't prepared to move to that dream house that you want.
Right.
If you prepare for it, you won't be disappointed. And the discussion will also be buying a home. If this is your first home, you have so many other opportunities to buy others, right? You want to always move up. Use the first home as a stepping stone, right? To make some money off of that one, move to my second one, move to my third one, till you finally get, if that's 4 homes down the road, so be it. It's 4 homes down the road. But at least you have something to take each and every time you move from home 1, home 2, home 3, and so on.
Okay, absolutely. Sharon, please tell our viewers how they can connect with you so that they can utilize your expertise.
Absolutely, absolutely. So again, I'm Sharon Eldorado. You can look me up, Google me. You'll see my name, and it's spelled Eldorrado. I'm with New American Funding. My cell phone number is 919-641-2576. Call me anytime, send me a text message, and I will respond.
Guys, don't forget, like and subscribe. We are here to educate you. So we'll see you next time.
Bye-bye.
All right. Well done. We did it.
So aside from my